Welcome to Module 20, which marks the final module in our course where we will wrap up our valuation and show you guys the output of our transaction comps. So diving first into the output just for the transaction comps and giving some more color to these and talking through them. So what we find once we roll our whole analysis up here is that precedent transactions imply an LTM EV to EBITDA multiple of about 12 to 14 times. Now, when I compare these multiples to our trading comps multiples, these tend to be quite a bit lower than what our trading comps were spitting out, especially when we compare it to Nike's or Lululemon's valuations, which were in the low to mid 20x in terms of EV to EBITDA. And I think the main explanation for this, and what I would really chalk it up to, is that identifying true comps with recent M&A deals was very hard in this case. So I would say that our trading comps is much more meaningful than our transaction comps. One could argue you'd throw out the entire transaction comps analysis. I would maybe make the answer a little bit more nuanced and say when you're faced with a situation like this, you should really anchor your valuation to one or two of the best transaction comps out there. So rather than relying on a full robust data set, I think it's much more valuable to find one or two really good precedents to anchor your valuation to. But another key consideration to take into account here is when we think about the size of the targets in these transactions relative to the size of Nike and just other operational metrics such as revenue growth, margins, etc. I think what we find is all these players are significantly smaller. I mean, Tiffany was the largest one here with sales of about $4 billion. And, they were purchased for about $16 billion in enterprise value. But even with that, Nike's market cap is about $140 billion. So there's just no comparison here on size metrics. And then when I look at growth, margins, those sorts of factors, I mean, you think about a company like Dickies, for example, where EBITDA margins were pretty low compared to Nike. I mean, that it certainly isn't that relevant. So that's another factor to consider, that companies like Dickies or a Reebok, let's say, may not be highly comparable, which I think further bolsters the case to really try to cherry pick and find the best comp from the set. So I think what we find overall here is that our transaction comps are spitting out a much lower implied LTM EV to EBITDA multiple. Now in the next lesson, I want to walk through the football field and how our per share price valuation differs between just looking at things on a multiples basis and then looking at premiums paid. So stay tuned for that.
Okay. You have my attention. I'm listening.